purpose of our getting together is to kind of review the outline of accounting, the basic procedures in journalizing information, posting it to the accounts, and then talk some about the statements that come about at the end of any accounting cycle that you pull out of those accounts. Along the way, I want you to do a couple, three things for me. First, introduce me to what you see as the big problems in taking that accounting course. I won't call it a curse. In taking that accounting course the first time, what's the most difficult challenge in it? Anybody? Because the attrition rate is apparently very high. A lot of people don't finish the course. Why?
For me, it doesn't go to a more basic level because it's like taking a foreign language. And even though there's an introduction to cost, assets, and liability, there's not enough time spent in that very basic area before moving forward. And there's a lot of pressure, even in the 2001 class, to move forward at a good clip.
Okay.
So about a third of the way in, most of the people in the class I had, and I had an excellent professor, were still trying to figure out, we were helping each other. What are we doing? What does this mean? Ledger and journaling, understanding more clearly what you pull from and where you go to, doesn't tend to make a logical sense to us who've not taken accounting before.
Good. Okay. I took bookkeeping in high school when I finished high school out in Texas. Did an entire year, and they had the documents prepared. We ran a small business, and we did the entire bookkeeping procedure for everything: sales, cash receipts, receivables, reconciling bank statements. And if we can get some of that skeleton down in terms of what's really going on, where the workflow's going, then maybe as they add to that with a little more depth on this topic, a little more depth on that topic, you've got a skeleton to hang the facts on to add to. So that's kind of what I'm going to do. I made kind of a real small handout for everybody.
We also were trying to apply it to different types of businesses, service businesses, and then manufacturing businesses.
Yeah.
Sorry.
This one's just real simple and straightforward, but before we start, what I really want to do is show you what these pages are. The first page is some transactions. We're going to go through those just to illustrate how we're going to do it. Look at the first page after that. That's a journal. The journal page. The journal is called the Book of Original Entry. Everything that happens in accounting starts in the journal. It's, the term journal historically meant you were just journaling, recording things that happened. And that's all we're doing here. But in the journal, you've got a date column, you've got an explanation column, and then you've got a debit and a credit column. Debit column and a credit column. This is all based on double entry bookkeeping. Double entry means every entry's got at least two parts, a debit part and a credit part. Debits always have to equal credits. It's the debits and credits I've seen that really throws people for a loop when they first get into accounting. Because does debit mean an increase or a decrease?
It depends on the account.
It depends on the account type. And if you're not aware of that, if you're used to your bank, for example, your bank says you put $100 in the bank says we credited your account for $100. And you think, oh, a credit means an increase. Why do they credit your account at the bank? Because for you, you're a liability to them. They owe you that $100. And so they credited your account because they owe it to you. That's a liability. In your business, if you put money in your business account, you debit your cash account. That's the difference. They're telling you what they did in their books, not what you did with your books.
Can you go over that one more time?
Okay. When you bring, I'm your banker. You bring me your receipts for the day from your business, $100, and you put it in the bank, and I say, we credited your account. What I mean is that in my bank, what I did is I said, Robin, accounts payable, because I owe you that. And I said, $100. That means I owe you $100 more because you gave it to me. I credited it. Credit is the right side of the T account. In your business, you're going to put down for your cash account $100 debit because this is an asset to you and you increased that asset. So when they say we credited your account, don't think of that as a credit. Think of that as a debit to your cash account.
So it's like if I took cash out of a drawer, a cash drawer, and I went to the bank and gave it to the bank,
Same thing.
that's why it's debiting, okay.
Yeah, anytime you increase, and this is the basic rule, right? Let's see if we can make a little pattern out of this. You've got 5 types of accounts. Let's look at this paperwork just for a second. Look behind the journal pages. I've made a separate page for each type of account. All these accounts, and we're using little T accounts. It has the left side's debit, right side's credit. Look at the first one. It's called assets. I didn't label each one of the accounts, but you could label the very first one up there in the upper left-hand column. Just put cash at the top of it. That's your cash account. What other assets might you have in the business? Most common one, accounts receivable, where people owe you money. So label another account, accounts receivable. What else might you have? How about equipment? Maybe the trucks or vans for your business. Another account, supplies. You go out and buy office supplies or supplies to use. You can make up whatever accounts you want to suit your particular kind of business. If you have a manufacturing business, one of your assets would be inventories. When you manufacture something, you hold it in inventory until you sell it. So the first set of accounts in the ledger has all the accounts. The first type of account is the assets. Second behind that, and you could call these, the 100 accounts. 101 is cash, 102 is receivables, whatever you like to do like that. The second sheet, look behind that, in the ledger, all of my liabilities. Now, what's a liability? Money you owe. You owe somebody something. Most common one, accounts payable. So take the first column, the first account on the top left, call it accounts payable. What is accounts payable?
Bills.
Yeah. If stuff comes in that you don't pay right away, you record it as, oh, I owe this. I have to pay it by such and such a time. And what's one of the rules for businesses? Managing your cash flow. You try not to pay your bills until they're due. Because if you pay them early, you're getting no advantage and you're giving up the use of that cash for a couple of days or a couple of weeks. So frequently we'll record stuff as an account payable and we'll put off paying it until we need to pay it. Another type of liability might be salaries payable. Maybe we owe some salaries that we haven't paid yet. And we'll design others as we go along. Third category, equity accounts. And when you look at them here, what we're going to do today, at least initially, is we're going to talk about a sole proprietorship, not a corporation. The sole proprietorship has, under equity accounts, really 2 of them we want to be concerned with, okay? There's the money you put into your business, or profits that you plow back into it that makes it more wealthy. And then there's the money you take out of the business to pay yourself. So in the equity accounts, label 2 of them. One is, this guy's name for this business is Sam Adams. So Sam Adams, comma, capital. And that's his real equity account of what he has in the business. And then when he takes money out, we use Sam Adams, comma, drawing. A drawing account is where he takes some of his profits out of his business to go back and pay his normal personal, not business, expenses. So we'll have 2 of those for right now. This terminology changes when we become a corporation. Okay, when we become a corporation, we got common stock, maybe preferred stock, and then we've got retained earnings, monies we plow back, and then we've got dividends that we pay. So we won't use those yet. It's just a simple substitution. These 3 types of accounts are basically the status of the business at any one point in time, like a photograph. If you could take a photograph of this business and they said, we have $1,000 in assets, $400 in liabilities, then what's left? $600 in equity. Because equity is always assets minus liabilities. So by definition, that would have a $600 balance. As we make more profit, We'll see how that evolves. We'll be adding that into the value of the business, the capital.
Liabilities is always money owed.
Liabilities is money owed.
Okay.
Now, what happens is assets have debit balances, liabilities and equity have credit balances. And we'll have to learn that litany. That way, 6 plus 400 equals 1,000. Debits equal credits, the balances. Again, these three accounts, we use them to build the balance sheet. And again, the balance sheet is like a photograph. It says, on this day, this is what I got. And we might look at the balance sheet in the business once every month, once every quarter, once every 6 months, once every year. And we'd be looking at it and see, how does it change over time? And what do you hope is happening?
Equity is growing.
Equity is growing. Yeah. All right, so far, those are our first three kind of assets. I'm sorry, accounts. Behind that, the other two type of accounts, we'll call them the 400s and the 500s, are the revenues. That's the next page or next sheet I've got in here. The revenue accounts. Revenues would be sales or sales income or fees income or popcorn sales or insurance sales or whatever it is you're selling. How did you get your money? And if you've got multiple sources of revenue, you've got multiple lines of business, then you're tracking those incomes separately to see how each one's doing. So you may have multiple revenue accounts depending on how your business is structured. But it's nice to know where the money's coming from and divide it up if it's coming from different areas. And then the last type of accounts are called our expenses. And you can imagine we could have a lot of expenses. We got payroll expense. We got entertainment expense. We got truck expense. We got supplies expense. We got expense after expense after expense. So literally you would have maybe 10, 15, 20, 30 expense accounts. So that when you paid for something, when you spent money, when you add an expense, you know what category of expense it is. That way we can go back and look at the business at the end of the year and say, how much did we spend for this? How much did we spend for that? Oh my goodness, why is that expense so high? And we can identify. We don't dump it all into one expense account because we can't control it. We can't monitor how we're performing. So again, we make up the expenses to suit our particular business. Now, revenues have credit balances. Expenses have debit balances. To me, that's the hardest part to get started with in accounting. When you're comfortable, I'm going to erase this and make up a little memory tool on how to remember what do you debit to increase it, what do you credit to increase it or decrease it. You okay? Can I erase the board?
Yes.
And I'm kind of making this up on the fly, but there's any number of different ways to do it. Assets and expenses. To increase them, you have a debit. To decrease them, you have a credit. Liabilities, equity, and revenues. To increase them, you give them a credit. To decrease them, you give them a debit.
Okay, say that one more time, please.
Okay? Assets and expenses are similar in the sense that if you want to show an increase in one, you give it a debit entry. If you want to show a decrease in an asset or an expense, you give it a credit entry. And if you just remember that, the next part you can logically figure out if you have to, right? All the other stuff, liabilities, equities, and revenues, work the opposite way. Credits make them more, debits make them less. So assets and expenses increase with a debit. You can hang on to that starting point and you can figure out what the credit is, because everything we do, there's going to be a debit and a credit.
I think the fail rate hinges on this part, as well as how the wording is on the drop-down menus or on the choices, where the name of the accounts you're putting things to.
Okay.
And moving things around. I think these two, for me, I don't know what you guys think. That's kind of.
This is where I saw most students, if they didn't get it the first day or second day, they were behind the rest of the term and they stayed confused the rest of the term. But if if you write that down somewhere and refer to it and doing all your homework, you do it enough, you start remembering it. Okay?
Assets and expenses, to increase them, that's a debit.
That's a debit.
To decrease them, it's a credit.
That's correct.
Liabilities, equities, and revenues, to increase them, that's a credit.
That's correct.
And to decrease them, that's a debit.
That's correct. Perfect.
Now, can you just do a example of that?
Yeah, we're going to do several.
Oh, okay.
We're going to do some journal entries now. In fact, I hope we do a lot of them where we get used to thinking in terms of debits and credits. We'll start with the ones I made up, and we'll make some more up in class, okay? First one, Sam Adams opens his business by moving $5,000 from his personal checking account into his business checking account. And all we're doing is we're keeping his business records, not his personal records, okay? So again, we go to the journal, the book of original entry. And in the old days, of course, this was all done with pen and ink. And when you wrote something in the journal, you were never allowed to erase it. You had to line through it and initial any change you made. That was as close as they could come to making sure you weren't fudging the books. So, what are we going to do? We're going to show the date, the explanation, and then we're going to enter amounts in the debit column or the credit column. And Sam's going to put $5,000 into his business. So, what's the debit entry? What's the credit entry? That's the challenge through all these entries. What would he debit?
Cash.
Cash. He's going to debit cash, $5,000. What's he going to credit?
His equity.
His equity. Sam Adams, capital. And when Mrs. Walker taught this to me in the 12th grade, you didn't abbreviate anything either. But if you get these concepts down, then doing this stuff on the computer is a whole lot easier. Okay. Let's do a couple more journal entries. Sam buys equipment to set up his brewery for $8,000 in cash. So, what do we debit? Let's see, this was January 1. This next entry is January 5th. He buys the equipment to set up his business for $8,000 in cash. I should have. Let's change that. Let's make that $3,000. I don't want him spending more money than he's got yet. So make that $3,000. What are we going to debit?
I would. Go ahead.
Sorry, the equipment.
Yeah, you ask, okay, what did he get? What increased? Well, it's an asset, it's equipment. So we're going to debit equipment, and again, you can make your own names up for the equipment. You might have different equipment accounts, right? Brewery equipment versus storage equipment versus whatever. And he paid $3,000, so that's that. What do we credit? He paid cash. So we have less cash. So to reduce his cash account, we give it a credit. And there's our entry. And puzzling through each of these entries, to me, is a challenge.
Now,
Once you get that, the rest of it's going to fall in place.
If you get the line of the debits and you start just calculating that at the end of the day, if the first one is a add and the second one is a subtract, how does that?
Well, remember, you have to go by account. Look at my cash account. This is where we use the T accounts, okay? If I were looking at my cash account, I would show the $5,000 debit on the first when I open the business. And then I would show a $3,000 credit when I paid for this equipment. That was on the 5th. If I ran a balance, I'd say, yeah, I got a $2,000 balance in my account.
So we're never going to tally the whole debit line on the journal?
No.
Because that wouldn't matter really.
No.
That's just,
It matters in the sense that your total debits better equal your total credits.
okay.
Okay? The computer should do that for us. Usually.
Except if you have the, yeah, we have to do it.
Well, most computers are designed so that you can't make an entry that the debit doesn't equal the credit. And the problem is when you don't know what to credit, then it gets to be a nightmare. Okay? In the old days, yeah, we'd run those entries and balance them. We should.
Our exams, at least from the professor I had, are handwritten in class.
Okay.
The quizzes and the practice work is on the computer, but everything's handwritten in class, so it's a very simple calculator.
Just a real quick rule of thumb. If you're trying to total up debits and credits, and they should be equal, if you come up with different numbers, 1090, 1009, you transpose some numbers. Find the difference in those numbers. How much difference is there?
81.
81. If the difference in those numbers is divisible by 9, it's high probability you did a transposition that way. Old bookkeeping trick. Okay? Hopefully with computers you don't have that problem. But as you say, sometimes in class, it's real easy to transpose a couple of numbers. So we keep, we'll run through some more of these journal entries just for a second. Sam takes a couple of bar owners to lunch to promote his beer, and he spends $150. Is that a legitimate business expense?
Yes.
Sure. He's out there advertising, promoting, marketing his business. How would you, and then what has he got to do in the real world? He's got to bring the receipt from lunch back, give it to the bookkeeper, and say, here, this is something I spent for the business. And I wrote a check out of the business checkbook, maybe, when I paid it. Or I paid it with the business credit card, whichever. So how would you enter that? This is on the 7th.
Are we doing 7? The 7th
Yeah.
or the 12th?
Sam, I'm sorry, I skipped one, didn't I? Let's go back to the 7th, I'm sorry. Sam buys the raw materials to start his first batch of beer. What did he buy?
Materials?
I'm not sure what kind of term you would want to use for it. This is going to be the barley or the hops or the whatever. So let's just call it beer materials, for lack of anything else, okay? What kind of account is that?
Inventory.
It's an asset. Okay? So he's going to debit beer materials, beer making materials, for $200. What's he going to credit?
Either cash or payable.
Right. We don't have the information here. Did he pay for it with cash? Or did he charge it off on his account? If he's got an account with the people where he buys his stuff, he goes in, picks up stuff, they put it to his account, he signs for it, and maybe once a month he pays off the account.
That would be AP.
That would be accounts payable. Okay? And if you do business regularly with a supplier that way, typically you would have an account there. You bring it back, you come back to your business and you've got all the materials in your car or your truck, and you put that in to make beer, and you go into your bookkeeper and say, here's the invoice from the supply house where I bought the stuff to make the beer. And the bookkeeper sits down and says, okay, we got $200 in materials, and we have accounts payable, and I'm going to put XYZ company, that's our supplier, for $200.
So the first one's an asset, and the second one is a liability.
Is a liability because I owe it. Okay?
Professor Strickland, I noticed that the running thing is that when you put it down, it all comes up under an expense. Am I correct? That's what the EXP stands for? Like everything starts off, like you have your date and you have your expense. So whatever you're writing, it has to be an expense.
Don't call it an expense.
Okay.
Okay? An expense is a particular category of accounts.
So what does the EXP stand for?
Well, this is the explanation or whatever.
Okay.
Thank you. I should be more clear than that. Mrs. Walker would hide me for that.
All right, and then I noticed that the next thing is under the DR, which is the debits.
Debits and credits.
And the credits is what, if it's gonna be like out of the cash drawer or out of the accounts bill, that's.
A credit means it's an increase in either a liability, an equity, or a revenue. Remember that? You're asking the right questions. We ought to do enough of them. I think you'll see the pattern.
Okay.
Okay?
Okay.
Don't try for a pattern quite yet because it's a little screwy.
And it's accurate, we always list the debit first?
Always list the debit first.
Okay.
Okay. Let's go to January 12th now. Sam takes these two guys to lunch and spends $150. Let's say he spent cash. What would be the entry? Did he buy an asset? No, he didn't buy an asset. So what's the debit going to be?
Kind of like an advertising expense?
Yeah,
or-
I would call it entertainment expense, okay? Although that's a dangerous one with the IRS. They always want to know what kind of entertainment you're engaging in and what was her name. Entertainment expense. And that's $150. What's the credit entry for that?
I keep going back to cash.
He paid for it with cash. So,
Cash.
credit cash. He spent cash. It's a reduction in cash. We reduce assets with a credit entry. We doing okay? Let's do, let me erase this and we'll start back at the top of the board in a minute. We okay so far, everybody?
This is exactly what should go on a first day.
I agree.
At least in 2001.
That's why I wanted to do this. I've done this for other students in past years. If you spend a day getting debits and credits straight and getting comfortable with how to puzzle out the journal entries, if you know that the day class starts, the stuff comes at you in a hurry. And now you have a way to categorize it. I'm hoping, at least that's what I've been told. Let's go to January 14th. Sam buys a truck for the business, putting down $1,000 and signing a note for the $9,000 due.
Double entry.
What did he buy? What did he get? Equipment or truck, you know? Equipment, in his mind, he might think, well, equipment is the stuff I use to produce the beer. I'll call my vehicles or trucks, okay? So he's going to debit the truck account. I now own a truck. That's an asset. For how much? How much truck did he get?
9,000.
$10,000, right?
10,000.
He put $1,000 down and signed a note for the $9,000. So he's got a $10,000 truck. And then what's his credit entry? It's got to
Well,
tell the
first we gotta
$10,000.
balance the 10 out, right?
Well, he paid cash, $1,000. And then what? He signed a note, so instead of accounts payable, we have notes payable. Let's say notes payable, the Chevy dealer, or whoever, for $9,000. There's your entry. So you can have one debit and multiple credits as long as they balance 10,000 and 10,000. Okay so far? Okay, January 20th, Sam sells his first batch of beer and he makes $1,000. We're assuming he gets $1,000 in cash. What's he going to debit?
Assets,
Which asset? What did he get?
cash.
Cash. He got $1,000 in cash. When you get cash, you debit cash. That increases it, $1,000. What's he going to credit? This is one we haven't used yet.
Like a sales or revenue?
Yeah. Let's put an account up here called beer sales. Or beer sales revenue. Because Sam's thinking that down the line he may start making wine too, and he'd have separate revenue accounts for wine. Okay? So, he's got a revenue account. Sometimes they call it sales, sometimes they call it revenue, sometimes they combine it. But whatever you want to call it, it's a revenue type, I earn some money type account. And to show an increase in sales, we give it a credit entry. So credit entry over here. Questions on that at all? January 22nd, he sells a second batch of beer, but this time he gets $200 in cash and lets the customer put the rest of the purchase on account. So how are we going to record that? And the assumption here is he sells $1,000 worth of beer. I didn't write that in there, I should have. Go ahead.
Cash and accounts receivable.
Cash what?
And accounts receivable.
Right. He got cash, $200. And the guy owes him money, so that's an account receivable. Nellie's Bar. For the balance. And the credit entry for that is back to beer sales. For $1,000. You okay with that?
Very clear.
Okay. Let's do one more on the 23rd. Sam buys $100 worth of gas for the truck and has $200 repairs done to it. And again, we'll assume he pays for this. Either writes a check out of the company checkbook or whatever, pays cash. How are you going to record that one?
That would be an expense.
Good. What kind of expense?
Truck expense. Repair.
This is where, as the owner of the business, you've got to make a decision. Do you want to keep your gasoline expenses separate from your repairs or maintenance on your vehicles? I think so. I want to be able to look at my truck account and say, how much money did I put into repairing that thing all year long? Is it a real limit or not? But if I put all these expenses together, I don't really know whether I'm paying a lot of money for gas or a lot of money for repairs. So making up names here, I'm going to say repair, let's say, put it this way, truck repairs, expense. Whenever we use an expense account as a safety factor, write the word expense. So you know it's an expense account. Just don't say truck repairs, say truck repairs expense. And that was $200. And then I had gasoline expense. Bought another $100. What's a credit entry?
300 cash.
In cash, if you paid cash. So let's do that. Make it easy. Cash, $300. Starting to see a pattern to this now. You have to know which accounts you have, and then you have to figure out which one do I debit, which one do I credit. Can I erase the board? So that takes us down to January 25th. Sam pays himself $400 out of the business. He takes $400 out of the business for his salary or whatever you want to call it. But we're going to call it, he's taking his money out of the business, not a salary necessarily. What do we know for sure is the credit? He took $400 out of the business in cash. So we know that the credit entry is cash for $400. But what's the debit entry?
Is it other equity?
It's a kind of equity, but it's a reduction in equity, which normally you might think, well, what were the two equity accounts? You remember that? We had
Retained
Sam Adams Capital and Sam Adams Drawing. So now it gets a little, we turn another little curve on you here.
So it has to be drawn, correct?
The drawing is a sort of contra equity account. It's a negative equity account. Drawing is money he's taken out of the business. Capital is money that's going into the business. It either comes from him putting it in or his profits when he makes them at the end of the year. So in this entry up here, conceivably, mentally, you might say, well, we could debit capital because that would reduce it. He took out capital from the business. But we keep a separate account showing how much he took out for himself. And so we would debit it over here, $400. Sam Adams, drawing. And so over the course of the year, we can see how much money Sam took out for himself. And if you had a couple of partners, you would each have your own drawing account. And we would post to that every time you wanted to take this money out of the business. Questions?
On the capital account, it would be on the right side.
Yeah, remember when he put the first 5,000 in?
Right,
We had a credit. So this has a credit balance,
but we drop it 400.
but this has a debit balance. This is a reduction in this. That's why I call it a contra account.
Okay.
It's kind of like saying, how much equity you got in the business? Well, let me look at my capital account and subtract from that whatever I have drawn out in my drawing, and that's my net equity.
So we don't do anything to the T accounts, we don't take it off of that 5,000 on the T account?
Not on this account, you just show it.
Okay.
So the capital one, you're gonna always add whatever income you get.
Any
You'll
income
always
that
pull
you
from
keep
that.
profit in the business and plow back in the business, when we do the books at the end of the year, we'll make that entry to show, out of all my profits, the part I didn't take for me, I left in the business, and we'll show that as another credit over here. Exactly.
So in the homework, somewhere in my memory from last semester, I thought we had to tally up the totals for each of the T accounts. But if we're not deducting the 400 from the capital,
You will at the end of the year.
okay.
At the end of the year, you're going to net these against each other.
But each individual T account is not balanced.
No.
Okay.
Each T account has a balance. You know, it doesn't have to have debits equal credits. It's got a balance, a credit balance or a debit balance. It may have multiple debit and credit entries on different accounts like cash, but it'll have a net balance,
Okay.
which normally is either debit, credit, depending on the kind of account. Okay, so far?